So joining us now is Harris Kupperman, who is better known to our listeners, Kuppy. Now, Kuppy's been publishing the blog Adventures in Capitalism now for many years, but we're proud to have him as a regular on the Market Huddle now in what we call Kuppy's Corner, which is the last week of every month. We're going to bring Kuppy on to pick his mind as to what's going on. So how you doing, Kuppy?
I'm doing great. Thanks for having me on the first episode of Kuppy's Corner.
Fantastic. And how you're out in New York? What are you doing out there?
I was at the Brookfield Analyst Day, but I promised to come on. So I stepped outside. I'm in a courtyard. There's some crying babies. There's helicopters. There's a ferry honking at me. If you hear some background noise, I apologize, but there's nowhere quiet in Manhattan.
Oh, no problem. All right. So listen, what I really was inspired to ask you about and get you pick your brain is talk uranium, because you wrote a great article on your Adventures in Capitalism blog on it, and I really wanted to share that with all of our listeners. So, you know, what struck me right away when I was reading it was when you were talking about the last bull and bear market cycle in uranium. And we had, before I had a chat with Rick Rule, and he shared with us a truism, which was that bull markets become the author of a bear market, and bear markets are the author of a bull market. And no better example of that is in the commodity markets, and particularly uranium. Now, you were an early investor into uranium back, was it like 2003? And you went
Something
through
like
that whole bull market. Why don't you take us through what happened back then?
So uranium back in 2003 was one of these once-in-a-lifetime sort of things. You see, there had been massive deficits for years and years and years after a 3 Mile Island accident. So there's a structural deficit. You have a situation where you have the megatons to megawatts program, where we were taking old Soviet weaponized uranium and turning it into supply for power plants, which basically took the price of uranium below the cost to produce it and bankrupted everyone. So uranium was just structurally way below the cost of producing. I think it was like $12, $13 a pound back then. And you had this looking forward that the program was going to end. And then what happened is the few producing mines started having problems. Cigar Lake flooded. MacArthur River had another issue. And suddenly all the utilities said, hey, wait a second, we're worried about our supply situation. And they all went into the open market and bought uranium, which probably would have worked out just fine. The difference is that you had guys like me who were hedge fund guys who went into the market and said, these utility guys are kind of slow and dumb. Let's buy all the uranium and sell it back to them $100 higher. And that's basically what happened. And so these utilities start panicking because every time uranium comes on the market, some hedge fund just takes it. And, you know, a power plant is kind of a giant paperweight if you don't have uranium. So these guys start looking, they're saying, oh, wow, like we have a problem here. I'll pay any price for uranium. And I'm worried, you know, normally we run with, 2 to 4 year supply, but I'm worried how it's going to work out. Let's just lock in 10-year supply. And yeah, the cost of uranium is a few percent of the cost of our power plant. So it doesn't really matter what price we pay, really. And they just start locking in the supply at 100, 110, 120. And I mean, it just ran the price. It was some crazy thing where once it started going, you just knew it was going to keep going because these utility buyers were in a panic. And, I didn't have any uranium participation back then. I was playing this through junior miners, which, just so everyone knows, is probably the worst possible way you can invest in the world. Every one of these management teams were criminals, but it didn't matter. I think there was like 11 of these when I started, or 12 or something. And I just bought equal parts of each. And it didn't really matter what you bought. They all went up, and they just kept going up. And I mean, I was coming into these at 10, 20 million market cap. And in a lot of cases, I owned 9 in each of these companies. And for about 3 years of my life, there was nothing I needed to do. I kind of woke up at noon, sold a bit of my position, went back to bed because literally nothing else in my portfolio mattered. I mean, my uranium book, a lot of these were like 30 and 50 baggers. And, my hedge fund at the time, when my uranium position got into the 30s, you'd cut it back. So every week, uranium stocks would go up 20, 30%. So I would just put in some sell orders to go back to bed because the rest of my book didn't even matter, really. And
Yeah, I know.
It was a great thing.
Oh, absolutely. I mean, I think from 2002 to 2007, Cameco went up like 2,000%, and that's the big boy, right? Like, I mean, these juniors would have just been exponentially even more leveraged to the upside. But then we've gone through quite a bit of a bear market since then, haven't we?
Oh yeah, I mean, in the end, the world's demand for uranium is somewhat fixed. And so once these utilities had locked in their demand needs, there really wasn't any more need for uranium. And you had issues. You had Fukushima. You had just this oversupply. And this oversupply has weighed on the market, and it's been adding and adding. You also have issues where the price of SWU went down, so you had underfeeding, which added excess supply to the market. You've just had supply come on. I mean,
Yeah.
when you think about the last cycle, the odd thing about the last cycle is that the whole time you actually had excess supply. The supply demand imbalance, and people I think missed this. You probably had excess supply more or less because you had a governmental supply, you had the weapons program supply. It was just really utilities freaking out and buying inventory. Um,
Right.
and what's different this time is that you actually have a supply demand deficit now. You actually have a situation where demand is 190-ish, going on 200 the next year or two, and supply from primary production is like 120, 130-ish. And then there's some secondary supply from underfeeding and some other stuff. But you have like a 30-ish, maybe even 40-ish deficit. And I mean, looking forward a year or two, and
Yeah.
that deficit keeps building each year. Plus, you have a situation where a lot of utilities ran down their inventory and they need to add inventory, which just puts excess demand on a constricted supply number. And so, you have the makings of a very good bull market.
Right. And so now one of the things you discussed was that at the bottom of a market, you want to see true capitulation in producers. And one thing I can, at least what I've heard, and you can confirm if that's the case, but there really is almost no new exploration whatsoever going in the uranium space. And even
Right.
then, a lot of the producers are cutting back. I mean, is this enough capitulation for you in your mind?
Well, as soon as you go into a deficit situation, you've seen some capitulation. And what we've had is quite a lot of capitulation. There's at least a dozen major mines that have shut themselves. You have a bunch of other mines that are running at well below where they should be. These are the ISL, ISR sort of mines in like Utah, New Mexico. You just have had a lot of supply come off the market. And
Right.
it's very different from say natural gas, where I clearly got it wrong. And I was writing about this. Like we never saw the bankruptcies in the gas producers, and so you keep having the supply come on. And uranium's different, that you had the bankruptcies and you've had the Langer Heinrichs that shut down, and it's just you had MacArthur River. You had all these other large mines that just are shut down, care and maintenance, and that's
So yeah,
hyping
that's
it all
right.
up.
Because MacArthur's shut down, and Cameco is buying uranium at spot, isn't it? Like it's
Well,
actually contributing to soaking that up, isn't it?
so I mean, this is I think why the trade is timely now. Okay, so you could have a supply demand mismatch, and it can go on for years because you'll work down above ground inventories, and you have users that say, nah, every time I wait 6 months to buy more, it's cheaper. Why do I have to buy more? Why do I have to finance this stuff on inventory? So inventories get worked down, and eventually, you have the turn. And in the case here, Cameco, who's the second largest producer, was looking at the situation, and they're saying to themselves, why the hell are we producing this stuff at 30, 40, 50, whatever their all-in cost is? And all-in cost is very different than the mine gate cost they quote you. It doesn't include corporate SGA and financing costs and depreciation and all this other stuff. So whatever their actual all-in cost, they're saying, let's say the cost is 50. Okay, why are we producing this stuff at 50 and selling it into these term contracts we have, when we could just go into the spot market and buy it at 25? And it's half as expensive,
Right.
and plus it cleans up a lot of that excess supply. And so that's what Cameco's doing. They've been very vocal that they intend to go into the market in Q4 and try to manipulate the market higher. And when the number two guy says we're going to manipulate the market higher because we stopped producing and we're going to absorb a bunch of excess supply, and the number one producer, which is Kazatomprom, says that we're not going to be adding any incremental supply, kind of setting it up so that Cameco can clean up the mess. It's bullish. Will they actually get the price up in Q4? I don't know, but Cameco is going to probably do the same damn thing in Q1 and then Q2. Eventually, they will have absorbed all the supply,
Yeah.
and they will push the price up. I mean, look, if you were a uranium guy that was trying to sell uranium, if you're a mining company, yes, you have to sell uranium to make your payroll. But if you're a guy who has inventory warehouses of this stuff and you don't really need to sell it this year because your financing cost is negligible, why would you sell it today when you can wait 6 months and maybe get 40? If you
Right.
believe Cameco, why would you sell your if you're a Japanese utility with some excess uranium that you're trying to dump, why dump it today? So I think you're going to have a
Yeah.
situation where the offers kind of melt away a bit, and Cameco will push the price up, and that's why I own a hell of a lot of UPC.
Yeah, we'll talk about that in a second. I really wanted, before we get to UPC, I wanted to quickly just touch on the growing demand. So we went from back like in 2011, where Germany and Japan are shutting down reactors, and the demand side was driving that, to now a wave of new reactors coming up in Asia and India. So you really think that the actual demand will start to appear in the coming years? Is that a good way of summarizing it?
Yeah, I mean, that's a great way to summarize it. Look, I don't like to generalize when you're talking in finance, but this is an easy situation for generalizing. You had a lot of power plants that were supposed to shut down over the last few years and the next 10 years. And almost every month, we get another headline that another power plant is going to be extended for 2 years, 4 years. And this is not just Europe, this is the United States, it's everywhere. In the end, there is no really good substitute for baseload power that's carbon neutral. you know, Eventually they will, run the solar panels, the wind farms, and then put it into a battery. But we're not there yet. So your choices are coal or nat gas or diesel or uranium. And these power plants are going to be extended for a couple more years. And every year a power plant's operating is 500,000 more pounds that gets absorbed. So that's on the existing plants. There's a whole ton of plants being built in India and China. And those plants need uranium. First thing, you have to stockpile a few years of uranium before they turn the plant on. But then every year incrementally going forward, they need more uranium. So you actually have growing demand. And if you look at the models from, say, 2 years ago, people saw demand actually shrinking going forward. So it's very, very different in terms of what the model looks like. And then you play it forward 5 or 10 years and you see, substantial amounts of incremental uranium needed versus what people thought just 2 years ago.
Right. Right. So, what was interesting in your blog, you talked about UPC, which is the Uranium Participation Corporation. It's a Canadian entity. It trades under the symbol U here on the TSX in Canada, and something I'm quite familiar with as a Canadian. But for a lot of international people, they're not aware of that this unit even exists. But you think that this is a great way of playing this uranium. So, why don't you talk about why you think this is the best way to play it?
All right. Well, I mean, let me start off by saying that if I had never played in junior mining stocks, I'd be a much wealthier guy today. and that, as I made in junior uranium stocks. I ended up losing a lot of that money in gold stocks. And I think that mining is a very difficult place to invest. It's capital intensive. You have permitting risk. You have geology risk. There are specialists like Rick Rule that seem to get it right, like over and over and over again. But I'm not one of those guys. So what I'm playing is the price of uranium going from 25 today to some higher number. And I don't know what that magic higher
Yeah.
number is. I don't know if the Kazakhs get it to 40 and they say, okay, we're going to increase production again and keep it at 40 so that, the Western guys never bring their supply online. If I was Kazakhstan, that's probably what I would do. I don't know if it overshoots and it goes to 60 or 70. I just don't have an answer to that. What I know is that everyone who produces this stuff is incentivized to get the price up suddenly, and they all have a bit of collective discipline, and the price is probably going higher. And Uranium Participation owns physical uranium in multiple warehouses. They own some hexafluoride. You got a little tiny bit of cash there. It costs you about 80 bips a year to hold on to it. It trades a few pennies below NAV. And I just think it's the best way to play this because, look, I'm probably early. I mean, I know I'm early. If I'm 1 year early and it's costing me 80 bips, well, it's a $4 stock. It's going to cost me about 3 cents. And if I'm 2 years early, I'm at 6 cents. The average daily range is about a nickel or dime. It's just totally irrelevant to the investment if I'm even 5 years early. If you're 5 years early in a junior miner and they have to raise money every 6 months to make payroll, well, there's going to be 10 times as many shares outstanding. You'll have nothing when the turn comes. This just seems like a much better way to play it. And yeah, you don't have that supposed operating leverage, but I've been told by a lot of people over the years that mining gives you operating leverage, and I haven't seen it very often. So, so I'm going to own this
Well,
uranium participation. It's marginable, which is great. And I don't think, I think it's one of these rare situations when you can take a very, very large position because outside of mark-to-market risk, which is a real risk if you're, monthly liquidity or whatever, your fund mandate is, But outside of mark-to-market risk, and maybe uranium goes to 20 before it goes to 50,
Yeah.
there's no permanent loss of capital risk outside of fraud. And I don't think there's fraud here. So
Yeah.
you could just sit on it and wait, and you're pretty much guaranteed that in the next few years you will double your money. And I can't say
Well,
that
you
about
know what?
any other asset.
Well, the one thing I like about it is for Canadians anyway, on the Montreal Exchange, they have options on the UPC, and so I'm able to actually even play it with options for even some further leverage. But I know it's not available for everyone. But anyway, thanks for sharing that. But Kuppy, before I let you go, I want to just get an update from you on Sting. Scorpio has been actually doing very well in the last little while. I saw a headline. I just wanted to know whether you thought it was actually relevant or not, but there was that headline about U.S. sanctions being put on to a number of these Chinese shipping companies like Costco Shipping and others with that uranium story. Does that in any way influence Sting? Probably not, right?
Well,
Is
it's
that
bullish. Every
yeah,
time that a government messes up existing trade routes, it's bullish because a vessel needs to be repositioned that wasn't scheduled to make a run. So every
yeah,
time someone in the government changes something, it's bullish. And it's definitely bullish for everyone. And even if it doesn't directly impact product tankers, it ends up adding an element of fear to things where large trading houses need excess inventory of vessels just in case, product tankers are the next one to get hit. And so,
yeah,
I mean, I'm super bullish on this. I don't know if you saw, but this week the company acquired 19 vessels, added to their fleet. It's about a 20% increase in the fleet. They overpaid a bit. You don't really want to see that, but that's life. But the insiders also put $15 million more dollars into the company, and Trafigura put $35 million in. And Trafigura sold
yeah,
for shares. And Trafigura tend to
yeah.
be the smart money in this world. And they took shares, not cash, and they put $35 more in at 29 a share, and we're trading below that today. So that's what the smart money thinks, and I think it's good. I mean, I'm super bullish.
So and the story, it's coming to the tail end of this year. That's the for all the scrubbers and stuff like that. Was there a date on that? When was the date again on that?
So there's no like set date. Okay, January 1st, you have to start burning low sulfur fuel. And the demand increase for low sulfur fuel is probably November or December when these vessels need to stock up the ports. So we're expecting charter rates to start increasing end of October and into November. If charter rates don't spike by end of November, I'm wrong. Uh, but I think
Yeah.
we're going to see a spike, and I think it's going to be very bullish.
So the catalyst is actually coming up pretty soon. So it's keeping an eye on. This is going to be a lot of fun. Anyway,
You know,
Cuppy, listen. Oh, sorry, go
one
on.
last thing I'd add to this. I've been doing this 20 years now, and I can't remember the last time I saw the CEO of a public company spend $500,000 on 3-month call options. And
Wow.
CEO of Scorpio just bought some out of the money call options and spent $500,000 in premium. So it tells you what he thinks
Wow.
is going to
Yeah.
happen in Q4.
Well, you know what? That gets me even excited. All right. Anyway, Cuppy, listen. Thanks for taking the time out of your investor day there, and enjoy the rest of your day out there. And thanks for coming on. And we look forward to another update from you next month.
Sounds great. Thanks for having me on.
All right. Thanks, Cuppy. Cheers.
Cheers.